Good afternoon, everyone. My name is Prayas Nupane, and I lead business retention and expansion efforts for the partnership. Thank you to all of you for joining today. I recognize some names that have joined us previously for DC Biz Chats. Definitely appreciate you joining again. And for all the new folks, welcome to DC Biz Chats. For those of you that are not familiar with the partnership, our mission is to promote business opportunities through the District of Columbia and to contribute to business retention and attraction activities. We do that in partnership with the Office of Deputy Mayor for Planning and Economic Development. And together we support businesses and entrepreneurs that are looking to open, expand, or invest in DC. On behalf of the partnership and our partners, the Hive, as well as Ward 7 Business Partnership, I want to welcome you today to our DC Biz Chats on creating and using financial projections to guide your business growth. We have an exciting hour in front of us today, but before we begin, I do want to go over some housekeeping rules or housekeeping items. Today's webinar, it is being recorded. We will be sharing that link with you after the event is complete. We welcome you to revisit the content and also share that with your colleagues who you think might find this content valuable. Please feel free to utilize our chat window to share your comments, thoughts, communicate with each other, and have discussions. Let us know who you are, your name of a business, and how we can find you. If you have questions for our panelists, please utilize the Q&A. We will be selecting a few questions towards the end of the session to answer. For today's session, closed captioning is available. If you would like to take advantage of that, click the CC, so subtitles button. You should be able to see closed captioning through that. So similar to last year, we are excited to bring some valuable content, but in addition to bringing in speakers, we have also added one-on-one technical assistance to our DC Biz Chats this year. So we will be providing one-on-one technical assistance to 5 businesses, and CFO Services Group will be providing that on behalf of the partnership. For you to be eligible to receive one-on-one technical assistance, you must respond to the survey that it will be sending to you tomorrow. The survey will contain some questions about some of your business financials, but also about how you thought the workshop went today. We will be picking 5 businesses to receive one-on-one partnership from the partnership side. But for those of you that would still like to receive one-on-one technical assistance, please reach out to us. Our partners at SPDC at Howard University have graciously agreed to provide one-on-one technical assistance. A reminder to everyone, at Washington DC Economic Partnership, we value everyone's opinion, and we hope that you share your thoughts and feedback in the chat window. But we want to be respectful of everyone's opinion, and we also respect diversity in thoughts, but please be respectful in sharing your thoughts and comments in the chat window. Now let's talk a little bit about the DC Biz Chat series. The Washington DC Economic Partnership has been doing this for a number of years now. It is our signature workshop series that support local businesses by providing expert advice, resources, and practical solutions. We bring together thought leaders like Manny today, as well as some of the local business leaders who are able to share their expertise with us. We will have additional workshops coming up later in the year, so please visit our website or subscribe to our newsletter to learn more about what is in store for us this year. Before we begin, I would like to acknowledge our sponsors, Capital One and Office of the Deputy Mayor for Planning and Economic Development. Capital One has been a longtime partner of the DC Biz Chat series, providing support to allow us to put these kind of programs together. So thank you, Capital One, for believing in us and really making sure that we're able to provide valuable content to our businesses in DC. And the Deputy Mayor's Office for Planning and Economic Development has been the partnership's primary partner for over 20 years, and we work together to support the business community. Now, I would like to introduce our community partners. Let's start with the Hive. Jess, let me turn it over to you.
Good afternoon, everybody. Outside, I'm so happy to be here. The Hive 2.0 is Anacosstia's co-working space and business development incubator. We have space for rent. We have office spaces as well as drop-in spaces for folks that are interested in affordable office space. Along with that, we provide TA as well. So I'll get that information over to Preyas. But again, like, you know, as a representative of the Hive 2.0, I'm just very, very happy to be here. Thank you.
Thank you, Jess. Yeah, it is a beautiful day, and we're definitely excited to be partnering with the Hive one more time. We really appreciate your partnership and all the work you do to support businesses in the community. Now, with that, let me turn it over to you, Deborah, to talk a little bit about Ward 7 partnership. We're really excited to be bringing this programming together alongside your organization, and we'd love to hear from you.
Hello, everyone. I'm Deborah Jones with the Ward 7 Business Partnership, and I want to thank the Washington Economic Partnership for having this Biz Chat. We've partnered with you a couple of times and done them in the past, and I think they're pretty informative and helpful to the small businesses and to the community leaders. We were originally the Deanwood Heights Main Streets. We started in 2009. So as the oldest Ward 7 Main Street, we have worked very closely and in different capacities with the other two Ward 7 Main Streets. One is the Minnesota Avenue Main Street. The director is Samantha Archibald, and it's controlled by WAKIF. And the third one, we actually formerly partnered with Marshall Heights for the Pennsylvania Avenue East Main Street, which started in October. And the director is Letitia Atkins. So we will be doing some revitalization over there on Pennsylvania Avenue. What we do is a Main Street, we do small business technical assistance with all of the businesses in our footprint and a little bit with businesses outside of our footprint. But we also do storefront improvements. We have a clean team. We make sure that we give guidance for access to capital and a whole myriad of other things. After all these years, I get phone calls for everything from asylum to, I don't know, things that I have no idea about. But, we try to answer as many questions as we can and to try to be the go-to organization for small business in Ward 7. So my contact information is Deborah Jones. My email is djones@ward7.com, and you have to spell 7 out. It's WARDSEVEN.com. Our website is the same, ward7.com. And you can reach me by phone at 202-398-6054. Or come by our brand new building at 4922 Nanny Helen Burroughs Avenue, Northeast.
Thank you, Deborah, for sharing your contact information.
I'm throwing it to Preyas, yes.
Awesome. And we certainly are excited about partnering with you one more time and really looking forward to working with you. And thank you for all the support that you provide to businesses in DC as well. So with that, let me welcome our presenter of the day, Manny Cosme. Manny will be leading the workshop for the next 45 minutes. And after that, we're going to jump directly into Q&A. I was planning on really embarrassing Manny with this long intro, but I have a feeling that Manny is not going to like that. So I'm just going to make it really short and sweet. Manny is the CEO and president of CFO Services Group, which he founded 8 years ago. He is an expert in the field of accounting and CFO services, having presented at the US Chamber of Commerce Town Hall, as well as in various other settings. And he is very gracious with his time in terms of providing expert advice to DC-based businesses. So thank you, Manny, for the support that you provide. And thank you for being a small business owner in DC yourself and providing this content to us today. So with that, let me turn it over to you. I'm going to stop sharing my screen and I'll give you the control.
All right. Thanks for having me. And thanks for that cool promo video that you guys shot. That was really awesome. So I feel like such a superstar. All right. So I'm excited. This is actually my very favorite topic of all the topics I talk about. This is my absolute favorite. Financial projections. This is near and dear to my heart. This is what helps your business actually succeed. This is it. This is it. You're in the right place. So I know it's a beautiful day outside, but you all are here watching this. And trust me, it will not be a waste of time. This will be really great for you. Now, I'm going to talk super fast because I have a lot of great information to offer you in a very short amount of time. So here's my warning. Watch this, sit back, absorb it. I'm going to talk kind of fast. I think you're all going to get recordings of this. So when you get the recording, then maybe watch it again, pause it, and some of the screenshots I show you so that you can kind of more deeply absorb the information. And then you actually use this. I'm going to give you some practical stuff that you can use. So watch it now, absorb it, and then take it back and actually do it practically, okay? And I know we're going to be doing some technical assistance, so I'm excited to be hopefully working with some of you one-on-one after this to actually do your financial projections. So let's dive into kind of what we're going to talk about today. So we're going to talk about learning objectives. So 6 steps to creating a set of financial projections. We're going to talk about why sales and revenue are not the same thing, despite what people think. How to translate your financial results into actual cash forecasts, so you know how much cash you're going to have. How to identify future cash issues so you can solve them now, and so much more than that. So a little bit about me again. My name is Manny Cosme, founder and CEO of CFO Services Group. We are a management accounting firm headquartered here in DC with clients actually all over the country. But we are a management accounting firm, which means that we do 2 things. We do the bookkeeping work. So we help businesses manage their finances through bookkeeping, paying invoices, all that stuff. And then we do financial strategy. So those 2 things, that's what a management accounting firm does. So this, of course, is focused on financial strategy. So it's taking all that great information, hopefully you're keeping in bookkeeping, and then translating it into actual actionable things that you can do with your business to make sure that you're moving the ball forward and you have the money to do it. You're not going to run out of money, right? So that's a little bit about me. I do run a business in DC. So, you know, I don't know this. I don't just know this stuff in theory. I actually practice it. I do my financial projections once a month. I look at them probably at least once a week. So this is what I do in running a business. So this is what you should do as well. So I'm speaking from my personal experience here as well when I share what we do here. All right, so with that, let's dive into the topic. So imagine that you've decided it's time to take a vacation. You've been working hard and want to reward yourself. So what's the first thing that you would do in thinking about a vacation? Now, hopefully what you said is that you would decide where you want to go. That's the first thing, you know, you may want to think about, right? It's your vacation and you can go anywhere that you want in the world. So what kind of vacation do you want? Do you want a beach atmosphere? Do you want to go to a metropolitan city? Do you want to go to a cabin in the mountains? Okay, so you got to think about what you want. And then based on your wants, then you can decide your actual destination. You can go to Hawaii, Paris, Smoky Mountains, you know, wherever you want to go. So after you decide the destination, now you have to plan the logistics, right? So how are you going to get to your destination? Plane, train, automobile? What clothes are you going to pack? How much money are you going to need to do all the things that you want to do there? Okay, who's gonna go with you to make the trip more memorable? So these are important logistics that will help you make the trip as smooth and enjoyable as possible, right? So why am I talking about this? Well, most people wouldn't dare to take a trip without selecting a specific destination and then carefully planning the trip. I know I certainly don't. I want to know where I'm going and what I'm going to do and everything, right? So why is it that most people fail to plan their business? That's the point. So planning for business growth follows the same principles. You first need a specific destination. What is your business going to look like when it hits certain milestones? How much revenue are you going to have? What's your take-home pay going to be? I know I want to know that as a business owner. How much am I going to be able to take home, right? How many employees are you going to have? What services are you going to provide? And so on. So you need that destination. And then you also need to plan the logistics of how you're going to get there. So great, now I know where I'm going to go. Well, what am I going to need to get there? How much money are you going to need to bring your business from where you're at today to where you want to be tomorrow? How many employees are you going to need? What product mix are you going to need? You know, when you sell multiple services, you need to know, well, how much are you going to emphasize of each one? How are you going to set your pricing? All these things. These are the logistics that you have to plan. So these are all incredibly important questions for you to consider as you start growing your business. Yet most business owners, from what I've seen, don't take the time to really sit down and think about these questions and plan their growth. Instead, they sort of wing it and then hope and pray that their business achieves some sort of success. So that's why I have the dice on the screen, because it literally becomes a dice roll on whether you're going to actually get there or not. We don't know, right? So I love this statistic. If you ever watch me do any presentations, I pretty much quote this in every presentation I do. So according to Intuit, who are the people who make QuickBooks, 20% of small businesses fail within their first year of business, and half of small businesses never make it past the 5-year mark. But if you work with an accountant, then you have an 89% chance of getting past those milestones. So the message is pretty clear. If you work with an accountant, then chances are your business is going to last. It's going to succeed. So why is that? It's always been interesting to me. Now, why is that? Well, if you think about it, it makes sense. Because working with a good accountant will force you to become disciplined about your business. They're going to ask you what your specific milestones are, and then they're going to help you figure out the resources that you're going to need to get there, and help you look at any obstacles that may be coming down the road, and help you start thinking about how you're going to get around those obstacles so you can get to your goal. Okay. So essentially what they're going to help you do is create a clear pathway to growth that now, once you create it, you just need to start following that pathway. And because of that, the odds of you actually getting there are greatly increased, 89%. I mean, those are pretty good odds. Okay. So very important. And if you don't create that pathway, then you could end up like the proverbial hamster on a wheel, which I talk about all the time. So, you know, you're running hard, you're running fast. You know, how many of you feel like you're running, you're exhausted by the end of the day, yet the business is not moving forward? You're like a hamster on a wheel, just running around. And what ends up happening is you end up getting exhausted and then feeling defeated. And then you end up back at these statistics here. So this is what happens. This is what we want you to avoid. Don't be like a hamster running on a wheel. I want you to actually plan your business and plan the resources that you're going to need, and then we're going to help you get there. So in the world of business, the process of setting your destination and planning your logistics is done by your business plan. That's where it all lives. So a business plan does exactly what its name suggests. It plans the growth of your business. So it outlines your milestones of the business to hit. It talks about what products and services you're gonna sell. It talks about your sales and marketing strategies, your competitor analysis, and it also has a financial projection. So the financial projection, in my humble opinion, is the most important part of the business plan, because it actually translates all of the subjective thoughts and opinions you have about the business, and it forces you to actually lay them out on paper in black and white. In other words, what it does is it translates what you want to do into actual reality and a step-by-step plan. So a set of financial projections actually does 4 main things. 1, it shows you what products and services the business will sell at the price and the quantity that you want to sell it at. 2, it's going to show you what resources you're going to need in order to make those sales. Okay, so what raw materials will you need to buy? Who will you need to hire? How many locations will you need, etc. 3, it's going to show how much cash the business is going to need in order to achieve the goals. So will you have enough cash, or will you have a shortfall? We need to know that, right? And 4, it's going to show you all of this as the business moves through time. So the business, if the business currently sells 2 products, when is it going to roll out the 3rd product? When does the next employee need to be hired? When do you need to get that next office? Okay. When you're going to hit operational capacity. So how long do you need to go before you need to borrow money? So as a business owner, you have to answer all of these crucial questions to ensure that your business is successful. So the financial projection again, in my opinion, really is the true business plan. It's going to show you how you're going to get there. So this presentation is going to show you a 6-step method to building a solid set of financial projections that you can use to plan your business growth. So we're going to walk through each of these steps and explain each in detail. So pay close attention. And again, for here, what I want you to do is absorb the information. When you go back and watch the recording, pause it like on this screen and all the future screens I'm going to show you so that you can really then take this into action, okay? And by the way, we are going to use a spreadsheet program to create your financial projections. I'm going to show you an example in Excel, but feel free to use any other spreadsheet program. Again, this is actually how you're literally going to create a set of financial projections that you can use. Okay, now if your business has been in existence for a bit, then you'll also need your financial records, of course, to start building financial projections, right? Your financial projections are going to tell you where you're going to go, but you do need to know where you're at first so that you can plan where you're going to go, right? And looking back at past information can help you look at trends and kind of figure out what you think is going to happen in the future. It's going to help you better predict what that future is going to look like. So make sure you have those handy and hopefully in an actual bookkeeping program like QuickBooks. Now, if your business is brand new or you haven't started yet, then don't worry about this. I know sometimes actually it's really great if you're a startup business to actually create your projections. That is going to be the plan that you can turn around and sell to investors, by the way. So FYI on that. Now, make sure, of course, your financial records are cleaned up. If you need help cleaning those up, reach out to a bookkeeper like us or anyone that you know to help you clean up those records so that we can make sure that you have good information so we can start building the future of your business, okay? So we're going to use a fictitious business here as an example to help illustrate the points as we move through. So meet Bob. There's Bob right there, okay? Bob is the owner of Acme Burger Joint, a small casual dining restaurant. He's hired us to help him create his financial projections and to grow his business. So we're going to build a set of financial projections for Bob and in the process, help you build them as well. All right. So let's start by quickly developing the skeleton of a financial projection. So it's actually best to literally project how the business is going to move and change month by month. So when you go back and watch this recording, I want you to fire up a spreadsheet like Excel or again or whatever. And I want you to do step number 1, the simplest step ever is just put every single month in its own column, January, February, March, April, May, okay? And what we're going to do is we're going to build the projections month by month. So there you go. So far, so easy, right? Hopefully. All right. So do that. All right. So let's dive in now with the work. So let's start with step 1, which is about setting your goals. So as the owner of your business, you decide the goals that you want your business to achieve, right? And once you decide those goals, then your job is to ensure that all the resources of the business are pointing towards helping you achieve those goals, and then to recognize when you're off course and rearrange everything so you get back on course. This is the primary job of the business owner. You are the proverbial captain of your ship, and your job is to make sure that your ship gets to its destination safely and efficiently. All right. So coming up with the goals for your business can be a bit difficult because it forces you to really think about what you want from your business. That's actually the hardest part, interestingly. Okay, but that's also the key. It's what do you want from your business? So as the owner of your business, this is all about you. Your business is a great tool that can help you achieve your goals and dreams. It can help you achieve a certain financial standing, of course, but it can also help you satisfy your other goals, like your creative goals, your sense of contributing to a community, maybe building a legacy for future generations. You can literally change the world with your business, okay? So what do you want from your business? So I want you to first start about thinking about what your personal goals are, all right? Now, in setting personal goals, it's important to be as specific as possible because we ultimately need to tie a financial amount to those goals. Why? Because like it or not, money is often the tool used in our world to exchange energy, right? So we don't want to get too philosophical here, but for purposes of this presentation, I'll just say that money helps us do things, basically. All right. So the more defined your goals are, the easier it will be to help determine the amount of money that you're going to need to fulfill those goals. So let's go to Bob. Okay. So let's say Bob's goal is to build a business that will allow him to have as much free time with his family as possible. So he can now drill into this goal to start getting a specific dollar figure. What kind of lifestyle does he want his family to live? Where does he want them to live? What kinds of activities do they want to do on a regular basis? What food are they going to eat? What does he personally want to do with his free time? Okay, so as he starts to answer these questions, he's going to start forming a more complete picture of what it means to have free time with my family, right? And then he's going to start realizing, well, I need a certain amount of money in order to be able to do all these things, right? I need a certain amount of money to live where I want to live and to do the things I want to do and eat the foods I want, in other words, okay? So in other words, he'll start creating some personal financial goals for himself. Now, this is a really great place to work with a personal financial planner to help you think about what kind of money you personally need in order to do all this. Okay, so I do recommend if you know a personal financial planner to work with one, and if not, feel free to ask. You know, we always know great financial planners here. So now we're going to take your personal financial goals and translate them into business revenue goals. So how much money does your business need to make in order to bring you the money that you need to fulfill your personal goals? This is how we then map your two together. We map the business to your personal and vice versa, okay? So again, your business is a great tool to help you achieve your personal goals. So we want to make sure that your personal goals and your business goals are mapped together. They're tied together. All right. And that's going to really give you the fuel to make sure that you're moving your business forward. It's incredibly powerful. So the translation of personal goals into business revenue can be a bit complex. So we need somewhere to start. So we're going to start with a general ballpark estimate of what that looks like. So the best way to do this is to take your personal financial goals and simply multiply them by 4. We're just going to do that to begin with. What this does is this gives us a nice ballpark benchmark for then what the business needs to bring in revenue wise. Now, we're ultimately going to go back and fact check all this to make sure it actually is working. So don't worry if this number is not 100% true. We just need some place to start. But that's a really good place to start. So take what you need to take home personally, multiply it by 4. So in our example, Bob meets with this financial planner and realizes that he needs $30,000 a month in order to do all the things he wants to do. Okay, so we simply multiply this by 4, and that means that his business now needs to bring in $120,000 a month in revenue. Okay, so we're going to start there with that being the goal. Okay, so now he knows he needs to generate $120,000 a month from his business, but how much is he generating right now? Okay, is he generating that much money, or is it much more, or is it much less? So again, we need good information to figure out where he's at today so that we can then start figuring out how we're going to bridge that gap to bring him to where he is tomorrow. So let's say in his example, we do have good records and we realize that he's actually generating $20,000 a month. So that becomes our starting point. All right. So chances are that you're going to be pretty far off from where you want in your goal. So right now he's at $20,000 and we need to bring him to $120,000. So we need a $100,000 increase there, okay? So this is why it's a future goal, right? It's something for you to strive to. So what we're going to do is we're going to say that this endpoint, this 120,000, we're going to call that a long-term goal. We're going to say that we're going to want to achieve that goal 5 years from now. And then what we're going to do is we're going to chop that goal up into smaller and smaller goals so it makes it a little easier to achieve. So a good technique is to take that amount of money that you ultimately need the business to produce and make that a 5-year goal, and then start backing it up into a 4-year goal, 3-year goal, 2-year goal, and 1-year goal. All right. So in our example, we're going to take the 120,000 and bring it back all the way back to a next year goal. So we're going to take 120,000 and we're going to chop it down. So today he's at 20,000. Let's say next year he'll be at 40,000, then 60, 80, 100, and finally 120 by year 5. So now what we've done is we've created some really great revenue goals that we can start working towards. Now we have a destination, we have a starting point and a destination, and now we know what we need to do to start working to bridge that gap. Okay, very, very powerful. So that brings us to step 2, which is forecasting our sales and revenue. So again, we know that Bob is generating $20,000 right now, and our first milestone is to bring this to $40,000 a month of revenue. So how are we going to do this, right? That's the $1 million question, literally. All right. So there's 2 ways that any business can increase their revenue. You can either increase your prices that you charge to your customers, or you can increase the volume of the product or service that you sell to your customers. Okay, one of those 2 things is going to help you increase your revenue. So your job as the business owner is going to be to decide which strategy is going to work best for you. So if you work with a CFO, a financial strategist, this is a really great place for them to get involved and figure out what makes sense. And each has its benefits and each has its detriments. So, if you increase prices, you may end up losing customers, but increasing volume may be a little hard to do. So this is where you need to get a little bit more into the strategy and figure out what's going to work best for your customer base. So this is where I do encourage you to work with a professional to kind of think about what strategy you ultimately want to produce. But the only way you're going to make more money is if you do one of these 2 things. So you are going to have to decide on a strategy. Okay. Now, once you develop a strategy, then I want you to think about how it's going to impact your revenue over the next 12 months. So for example, if you're focused on increasing volume, then you may need to figure out what your customer churn rate is going to be. And that's the number of customers you gain minus the customers you lose. If you decide to focus on pricing, when are you going to roll out the pricing changes? Okay, how is that going to impact your customer base, et cetera? So maybe you decide to focus on both, or maybe you decide to focus on rolling out a new product and come up with new pricing. Okay, so again, this is where you're going to need to dig down deep, work with a professional, and help you think about how you really want to implement this strategy. Now, to help you think through this, I want you to first identify what types of revenue you're currently generating, and then think about what you're going to change. So there are 3 basic classifications of revenue that a business can have, just for your information. There's recurring revenue, project revenue, and product revenue. So recurring revenue is a service that once you sell it once, it keeps bringing in revenue automatically month after month. So when you think about how this revenue is going to change over time, you have to consider what your churn rate is. Okay, that's the number of new customers you get minus the existing customers that you lose month after month. Then to get the total revenue that you're going to generate, you need to multiply the number of customers by the price you charge per customer, right? Project revenue is a service that you only sell once, and it brings a large amount of revenue typically. However, this can take a lot of time for you to generate. So think of a big contract that you sign, a $100,000 contract. It may take you some time to sell that contract, but once you sell it, you can bring in a lot of money at one time, okay? Now, the caveat there is that to fulfill that contract, you're going to fulfill that over time. And that becomes a difference between sales and revenue, which I'll talk about in a second. Product revenue is a product that you sell and fulfill immediately at the point of sale. Okay, so this helps you scale a business really quickly by selling product, because typically you can sell that in mass quantities, but they're typically priced at a really low price point. So you do have to sell a lot of them. But once they're sold, the deal is done immediately and you get the cash immediately. So the point is, the most financially strong businesses actually have a mix of all 3 types of revenue. So as you start thinking about how you're going to grow your revenue to hit your goals, I want you to think about which revenue stream you're missing and what can you introduce into your business. That will actually make you a stronger business overall and help you reach your goal. So for Bob, he's a smart business owner. He works with a great accountant. And so what he did was he created a bunch of revenue streams here. Okay. Now, I'm not going to go over this in detail because of time, but when you watch the presentation again, pause it here and look at how he thought about each one of these revenue streams and see if you can apply this to your business. Okay. Now, the point is, what we're going to do is we're going to take this information and now we're going to put it onto our projection spreadsheet. So this is what a projection spreadsheet starts to look like. We're going to take all the ways that he sells and we're going to start mapping it onto a spreadsheet. So we're going to take recurring revenue and we're going to say the number of customers we have, the new customers, the attrition we're going to have, That brings us to our current customers. We're going to multiply that by the price we charge per customer, and that brings us to the total amount that we're going to sell. And we're going to do that month over month. So this is where you start thinking about every single month, how many new customers am I going to bring in? How many customers am I going to lose? What am I going to charge them? And then you piece by piece start figuring out what your business is going to look like month over month. So again, when you watch the recording, pause it here and take a look at what's happening and see if you can apply this in your business. So we look at recurring revenue. We look at project revenue. How many projects do I expect to sell this month? How much am I charging per project? So that tells me how much money I'm going to be selling, right? Products. What do I charge per product? How much quantity do I anticipate selling? Okay. So we're going to do this for all of our revenue streams. And then at the end, we're going to get our total sales. All right. So a quick note about sales versus revenue, because this is actually a really important thing to understand. So sales and revenue are not interchangeable terms. They're actually two different things. A sale is made when an agreement between the customer and the business is signed to buy and sell something. So the revenue from that sale is recognized when the terms of that contract are fulfilled. For many businesses, this actually happens at the same point in time, which is why it gets confusing. So, but sometimes they don't happen at the same time. So for example, let's say that you're an event planning company and you got a contract to produce a gala event 3 months down the road, okay? You're going to sign the contract today. You're going to recognize the sale today, but you're not going to fulfill the stipulation of that contract for the next 3 or 4 months, okay? This is important to understand when it comes to projecting your cash flow and your expenses. Because when you sign the contract today, you may get a deposit today, okay? You may get some money in the door today, but you're going to fulfill that contract a few months down the road. That's when the expenses associated with you fulfilling that contract are going to be incurred. So your cash out is going to actually be a few months from now. It's very important for you to understand that. So when you're starting to plan your cash flow, you know when cash is expected to come in and when it's expected to go out the door. Okay. So keep in mind that sales and revenue are two different things, and you do actually need to plot both of them separately on your spreadsheet. So in our example here, we have our sales, and then below it, we have when we're going to recognize the revenue. And you're going to see in our next section that we then tie the revenue to the expenses that we're going to incur in producing that revenue. It's not tied to the sale, it's tied to the revenue. Okay. So again, some examples there. Take a look at it when you have some time to kind of see what's going on here. All right. So next we're going to move on to our expenses. So fulfilling our sales agreements, of course, don't come for free, right? It costs money to generate revenue. We got to pay for the thing we're going to produce. So we need to understand exactly how much it's going to cost for us to produce the sales and revenue that we just determined. So in the world of business, we actually split our expenses into two major buckets. So the first bucket is what we call direct costs. And that's what it costs us to actually produce our product. We call these cost of sales or cost of goods sold. So you may have heard that term before. That's what that means. It's the direct cost of us actually producing what we sell. The second bucket are the indirect costs to keep the business itself running, and we call those GSA expenses, general sales and administrative expenses. Now, it's important to distinguish between the two types of expenses for financial analysis purposes, because they'll help you determine the overall health of the business and make better strategic decisions. That's a deeper topic I can't get into right now, but suffice it to say that if you start working with a professional accountant, they're going to want to know the difference between your direct costs and your indirect costs to help better guide you in your business and make better business decisions. So very important to split those out. So there are three types of direct costs associated with a business typically: labor cost, resale inventory cost, and raw material costs. So labor cost is just the amount that you pay to actual people to help deliver your product or service. Now, they can be employees or independent contractors, but it's manpower. It's people actually doing stuff. Resale inventory is the cost of something you purchase at wholesale and then turn around and mark it up to retail to customers. And raw material is the stuff that you pay, that you buy, that you end up converting into another final product and then selling it, okay, again. So typically businesses have a mix of all three of these. So it's important to understand which ones you have, because each one follows a different rule. So by the way, a general rule of direct costs is that they will increase as your revenue increases. So in other words, the more you sell, the more costs you will typically incur. It makes sense because you're selling more stuff, so you have to pay to produce more stuff, right? So it becomes a cycle there. So that's important because when you go to create your projections, you first need to figure out what your revenue is. Then you can figure out what your direct cost is, because the cost is determined by the revenue. So first I figure out what I'm going to sell, and then I figure out how much it's going to cost for me to produce the thing that I sell. Okay. And again, if you have a difference in timing between sales and revenue, make sure that the direct costs are timed with your revenue, not your sale. Okay. Again, very important there. So in our example, we have some costs that we've determined that Bob has here. Again, pause it at this screen when you watch the recording and see what exactly we're doing here. But this is how we've determined the costs that Bob has. And then we're just going to map it onto the spreadsheet. So again, this is where you want to pause it and map it onto your spreadsheet. And as you can see, we have all the different types of costs. And what we've done is we've figured out kind of what it's going to take for him to actually produce the revenue that he's deciding there. All right. And then now that brings us to the GSA cost. So now that we've tackled the direct costs, now it's time to move on to the indirect costs of the business. So these are called GSA expenses, which stands for general sales and administrative expenses. So indirect expenses come in basically three different types. There's sales and marketing expenses, which is related to the growth of the company. So it's acquiring new customers, right? And building the brand reputation of your business. Okay. Management is all about the management of the company. So this is the executive management. So let's say if you're a business owner, when you put on that CEO hat, this is where you start thinking about strategy and whatnot. So these are expenses related to that. Business coaching is one of these expenses that typically we see businesses have. So if you have a business coach. And then finally, you have your general overhead, which is kind of everything else: rent, insurance, legal fees, kind of all that stuff. All right. So as with, so let's talk about fixed versus variable costs. So when we talked about direct costs, all of those are typically what we consider to be variable costs, which means that as your revenue increases, we expect those costs to be increasing. Okay, that's a variable cost. But some of your indirect costs may or may not be variable. Some of them may be fixed in nature, which means that as your revenue changes, these costs may or may not change. This is important for you to understand so you can start thinking about what indirect costs you're going to need to support your business as it starts to grow. So as my revenue increases, is my rent going to increase? Is my insurance going to increase? Are my sales and marketing costs going to increase? This is going to help you start thinking about how to project your indirect costs as you move through time. All right. So we have some examples here of some of the expenses in all three categories, as well as whether they're fixed and variable. And again, I encourage you to, when you watch this recording, to pause it here and take a look and then see in your business if you can make some similarities there. What are all your costs, and are they fixed and variable? And then when we bring it into the spreadsheet, as your revenue changes, how are those expenses then going to change? Are they going to change? Are they not going to change? Okay, that's how you're going to think about this. Are your management costs going to change as your revenue increases? Are your overhead costs going to change as your revenue increases? Probably not. That's the good news, is that you can start selling more and start driving a bigger profit if you have fixed expenses, because they're not going to change. All right. So after all that, we then take our revenue minus our direct costs minus our indirect costs, and we end up with net profit. And then we can see that right here on the spreadsheet. And hey, that's awesome to know, right? Which brings us to cash flow, which is the thing every business owner is ultimately interested in. All right. You can't grow a business without cash, and you definitely can't leave the door open. All right, the door's open. In fact, poor cash flow is the one thing that can sink your business faster than anything else. So this is a very important thing to pay attention to. Now, it's important to understand that your profit does not equal your cash. Just because you sold something does not mean that you actually got the cash in the door. Makes sense, right? Because maybe you invoice your customers. You know, we do some work for our clients, we send an invoice out, and then maybe 30 days, 60 days, 90 days later is when the cash actually comes in the door. Okay, very important, because as you start to look at your revenue, that may not be cash coming in the door. Yet, when you sell something and you start to fulfill it, most likely cash has to go out the door in order to pay for the thing that you're producing that you ultimately sell. So sometimes there's a difference in cash flow, and that's where it becomes really important. In fact, sometimes businesses can actually sell themselves into bankruptcy. What happens is they sell so much, they start fulfilling it, they start paying for the cost to fulfill whatever they sold, but they haven't got the money from the customer yet, and then they end up running out of cash. It's actually happened several times. So be very careful. Definitely pay attention to your cash flow here. All right. So some common things that we do is we have to take profit and translate it into cash. So some common things that we want to look at is we have our profit. Do we have receivables? Do we have payables? Do we have loans we have to pay back, etc.? We're going to take all that and adjust it to ultimately get to cash. So in our example, I encourage you to pause this and take a look at this, but we have Bob's profit, and then there's some adjustments that we're going to make to ultimately get him to his actual cash flow. How much money is he going to have in the bank? That's what we actually want to know. And then we're going to, again, put this all into our spreadsheet here. We're going to see, here's all the cash inflow that he expects. Okay. We're going to see all the cash outflow that he expects. So again, pause it here, take a look, see what we're putting in there to determine what's coming in versus what's coming out. And we get to a total cash flow for the month. And then we look at his beginning cash balance plus or minus the cash flow, and we get to his ending cash balance. This is very important for you to be watching all the time. What is your cash going to look like? All right. The truth is that cash looks like this in a business. There are periods when you'll be cash rich and periods where you'll have cash deficit. Especially as you grow your business, you will probably get into a deficit at certain periods of time. You have to watch this so that you can start figuring out how you're going to bridge that gap. This is where the business will die if you're not careful. Okay, this is what we call the valley of death. Your business will die as you grow if you're not watching where the cash deficits will happen. So going back here, every time you see a negative number at the bottom, that's where you want to watch and make sure that you start coming up with a plan on how you're going to bridge that gap. Get a loan, line of credit, outside investment, whatever you need. All right, and then that brings us to the last step, which is simply updating the projections. All we're doing here is making sure that you update the projections. This is a living, breathing document. It's not a one-time and it's done. This is something you have to update regularly because your goals are going to change. Your business is going to get off course. You're going to get curveballs thrown at you and whatnot. Your projections won't turn out to be reality. You know, they're just projections. They're not reality yet. So you need to step back and adjust these at least once a quarter. Update your personal goals, then update your business goals, then adjust your business projections, course correct for if you've got off course. Make sure you're doing this on a regular basis so that your business does ultimately hit its destination, which is what you want, your ultimate goal there. And by doing all that, profit is the result, hopefully, and you achieve your business goals and everyone is happy. So of course, if you need help, we do provide a fractional CFO service. Happy to talk with you offline about that. We are going to be providing some technical assistance as well. That's it. There's our information. So with that, I know I talked really fast, but I will open it up for questions.
All right. Thank you, Manny. That was a lot of content and a lot of great content. I'm sure like everyone is taking some time to digest. So I do have a couple of questions that I want to get started with, if you're okay with that.
Yeah, let's do it.
All right, cool. So one of the questions that was asked was, what are some of the common mistakes that businesses make while making financial projections?
They don't do them and they don't update them. I would say that's probably the biggest things. I mean, there's a couple of things, but honestly, make sure that once you do a set, you then update it, because your first set of financial projections, you're probably going to be very wrong. You'll get better at them over time. And again, your scenarios will constantly be changing. Your, reality will be different than what you project. So it's not just I create this and it's done. It's literally, I actually update my financial projections once a month. That's how often I do them. At the end of the month, I then sit back and I adjust my future projections, right? Based on what actually happened. What do I think is going to happen now moving forward? So that's what I say is probably the biggest mistake that people make.
Great, thank you. So I'm just looking at some of the questions that are coming in. So I'm just going to read the question to you, Manny, and you can just respond. How do you escape the valley of death? Should you try to obtain a loan based on account receivable, or are there other solutions?
So how do you escape a valley of death? So that's the cash deficit, right? So that's, I'm running out of cash. How do I get over that? So yes, loans, of course, that's typically what people do. So you go out, get a small business loan. There's a lot of great organizations here in DC. I've heard a few of them mentioned earlier today, WDCEP, for example. They exist to help provide loans to small businesses. So yeah, absolutely, get a loan. And when you go to get that loan, make sure you let them know how much money you're actually going to need. How do you know that? By doing your projection. You're going to see what that deficit's going to look like. And now you know the exact amount of money that you're going to need to get in order to get through that. So that's what I would say. And it's going to happen, by the way. You cannot escape the valley of death. You cannot escape a cash deficit in a business. It's very, very difficult. You at some point will go into a deficit if you are growing a business, because here's the deal. You're selling, you're going to hit capacity where you can't sell one more thing unless you go and hire a new person or buy a new piece of equipment or whatever. The minute you do that, you now incur more expense, but your sales are pretty much still where they just were. So your expenses now probably exceed your revenue. It happens all the time. And so because of that, you start getting into a cash deficit. So if you're really growing your business and really want to hit your goals, at some point, you're probably going to hit a deficit. So start thinking about how you're going to get through that now. It's actually I hate to say it, but it's actually a good sign that you actually are moving the business forward. You're pushing the envelope. You're moving forward there.
All right, thanks for sharing that, Manny. I'm going to keep moving. There's a couple of questions that are coming in. One is, looks like a lot of people are fond of the spreadsheets that you provided, and they want to know where they can find that spreadsheet and if there's a template that they should be using for this. Yeah,
we can give that out, or you know what? If you shoot me an email at that info at, I can share that with you. Yeah, I can give you that spreadsheet, that example.
All right, so that's perfect.
Yeah, actually, it'd be great, because then you can take the video recording and then you can have the spreadsheet alongside and just alter it for sure.
Yeah, that sounds great. Thank you. You mentioned about updating this on a quarterly basis. What happens on a yearly basis? Once you review it on every quarter, is there something that businesses have to do annually? Look at like all 3 quarters and see how the projections have changed, or what is your recommendation on that?
No, I recommend you do that exercise. Like I said, at least once a quarter, if not once a month. I mean, I do them once a month, but I know sometimes it's a little much. So at least once a quarter. Like, you don't want to wait until a year, because that's too much time that's passed. And it's too much to think about, too much data, right? If you do it on a short time period, you can, like, small business changes fast. Big business is slow to change. That's part of the problem, right? Big business is slow to change. Small business changes very fast, literally day to day. You can have major changes in your business. So the less time that goes by, the faster you're going to be able to recognize when you're off course and then make those course corrections. And that's what it's all about. Am I still on track to hit my goals? And if not, what do I need to do to get back on track? All of a sudden, am I projecting a cash deficit? Hire another employee? All these things, okay? So you want to do it regularly.
Okay, That sounds great. One other question that has come in. At what point would you recommend to start working with a professional versus trying to do this on your own?
I mean, well, I would say from day one, but I mean, we work with a lot of startups that haven't even actually technically started up yet. So, you know, even if you're pre-revenue, because if you're trying to get money, if you're trying to get a loan or investor or whatever, I mean, you're going to have to come with them with a business plan. I promise you the first thing that the investor is going to want to see is your financial projections. They want to know, well, what are your financials going to look like, right? How much, because your financials will answer all of their questions. It's going to, again, show them, what are you going to sell? How much, what are your prices going to be? How are you going to market this? How are you going to sell it, right? What are your actual costs going to be? The financial projections is your entire business. It tells you everything you need to know. So even before you start selling day one, your financial projections will help you create the plan for what you're going to do. Certainly after day one, if you're in your business, I mean, you should definitely be doing these. Again, the whole point is making sure that you have the resources you need so you beat those statistics. I don't want you to be the 1 and 2 that fails in the first 5 years. I want you to beat those statistics.
That sounds great. Thank you, Manny. So I know we're running out of time, so definitely want to thank you for the presentation. Would you mind clicking to one more slide, please?
Oh.
Since you have there we go.
There we go. Cool.
All right. Well, thanks again, Manny, for providing us with some valuable information today. We certainly appreciate the work you do supporting businesses, but also providing this information today. And thank you to our partners, Ward 7 Business Partnership, as well as the Hive, for being a good partner with us in bringing this content together, but also supporting businesses. For our attendees, we will be sending out a survey tomorrow, which will have some questions about the webinar itself and some questions as it relates to your financial projections. And those questions are going to help us understand what kind of support you need. If you would like technical assistance, please let us know. We will be referring you to our community partner at the Small Business Development Center. With that, I want to thank all of you for joining today, and we look forward to bringing more content for you in the future. Thanks, everyone.